Welcome to Inside Value Investing, a Hotchkis Wiley podcast featuring conversations with our investment professionals about markets, investment opportunities, and our approach to value investing. The views expressed are for informational purposes only and should not be considered investment advice.
Hello, everyone, and welcome to Inside Value Investing. I'm Mark McMahon, and I'm joined today by Doug Campbell, Portfolio Manager at Hotchkis Wiley. Today, we'll be discussing the impact of AI on application software. Hi, Doug. Thanks so much for joining.
Thanks for having me.
So let's get started. It seems the consensus view right now on Wall Street, Doug, is that AI is a real threat to application software. And I saw you recently wrote an article suggesting that AI is likely to be more of a tailwind rather than a headwind for Workday. What is it that you think the market's getting wrong?
You're right. The market is valuing the application software sector as if it's in the AI loser bucket. We think this is too simplistic a framing. Certainly, many software businesses are at risk. Those that are lightweight point solutions, these are the types of products that are easy to install, they're easy to replace, they're sold on short contract durations. We've always considered these types of businesses to be low quality. We've avoided investing in them. Workday, though, is very different. It's a deeply embedded mission-critical system. It runs core HR and finance processes for large enterprises. And these are the processes in a company that just can't fail. And they're highly scrutinized by regulators and auditors. Ripping out a system like Workday is costly from a direct expense perspective, but it's also costly because it comes with a lot of risk. And so customers are just unwilling to switch products. In the market, clearly there is a raging theoretical debate around the impact that AI might have on software over time. What we can observe today is that Workday's business is strong. Gross revenue retention, it's very high. It's stable at 97%. Customers, industry consultants, they tell us that customers really are not planning on churning at higher rates than they have in the past. And new businesses continue to sign up with Workday. So last quarter, about 40% of Workday's subscription growth came from new customers. This includes the largest AI labs like Anthropic, who has decided to replace existing back office software vendors with Workday. We look at the churn rates, we look at the net new business trends, and we think Workday should be a durable part of enterprise IT stacks for a long time.
Great. So, Doug, when it comes to AI coding tools like Claude Code, make software much cheaper to produce, why doesn't that significantly lower the barrier to competing with a firm like Workday?
Writing code has never been the hard part of building a scaled enterprise software business. If you look at the numbers, I think it tells the story. So Workday's cumulative operating expenses over the last 2 decades since it was founded, about half is R&D. And within R&D, only a portion of that R&D expense is salaries for coders who are spending their time actually coding. If you look at the other half of OpEx, it's sales and marketing. So these are things like building a trusted brand, building strong relationships with executives at large enterprises. These are intangible assets that have been built up over decades, and AI is really not automating this sales and marketing process yet. When you look at the cumulative cost structure of a scaled enterprise software company like Workday, there are clearly realistic AI savings in that R&D bucket, but only in a portion of it. It's really not a transformative change to the cost structure of a potential Workday competitor. If you look at the flip side of AI coding tools, Workday has access to the same tools, so they can use these tools to improve their own products. And historically, if you talk to customers, one of the main complaints about Workday, one of the main weaknesses to the product has been its clunky user interface. And with new AI tools now, Workday can develop more prompt-based user interfaces that really have the potential to improve the user experience. We don't think that AI coding tools dramatically reduce the entry barriers to competing with Workday. And we also think that these tools allow Workday to potentially improve its product over time.
We continue to hear quite a bit about AI job disruption. And so when you think about the disruption and as AI agents replace white collar workers, doesn't that then put more pressure on Workday's seat based revenue model?
Sure. So to start, AI driven layoffs haven't really shown up in the broad employment data yet. Even if you zoom into software engineering roles, for example, and software engineering is one of the professions, probably the profession with the clearest AI driven productivity gains to date. Even in software engineering, I don't think it's obvious that there are AI driven layoffs that have happened yet. We don't think that this is happening yet. And I think radiology actually is a good historical example that might explain why we're not seeing massive layoffs yet. If you go back about a decade, AI thought leaders were telling us to stop training radiologists. The reason being, AI was getting so good at reading images. And the theory was AI is in short order going to replace radiologists. There's not going to be a role for humans to provide that service anymore. If you fast forward to today, radiologist demand is at an all-time high. And radiologists are among the best paid specialists in the medical field. So why is this? Why did this happen? I think it's because radiologists' jobs are a bundle of tasks. It's not a single task. And most of what radiologists do all day, about 2/3 of their tasks are not automatable with AI. At the same time, you have AI tools leading to cheaper imaging, which drives more demand for radiology services. And you have this dynamic where human radiologists remain a bottleneck in a growing industry, and they're able to capture high compensation because of that. We think that most white collar jobs are going to look something like radiology. They're bundles of complex tasks that can't be fully automated with AI. And so we don't think that AI will lead to drastic job losses over time. But even if we're wrong and headcount does fall precipitously at Workday's customers, the company has offsets in its revenue model. So Workday today is shifting towards a consumption-based pricing model and away from purely a seat-based model. Workday also is developing the very agents that may replace some of these white collar workers. And so Workday has the potential to capture some of the value that's created there. And finally, Workday's contract structure, it helps protect them against the downside scenario. So Workday's contracts are multi-year durations. They carry inflationary plus pricing escalators. And so customers pay more each year, even if headcount is flat. And if customers want to reduce seats, they often will lose access to attractive discounts that they've spent many years negotiating with Workday. When you look at the totality of the contract, overall, it's challenging for customers to spend less on Workday over time unless they're willing to rip out the software entirely, which, again, we see is not happening because of that very, very low churn number.
Thanks, Doug. So I guess another narrative and perhaps the scariest bear case, if you will, is that a new AI orchestration layer gets built on top of systems like Workday, commoditizing Workday into just a dumb database. What's your take on that?
So this is a real risk for many software companies, especially so for those lightweight point solutions that I mentioned earlier. Core back office systems like Workday, we think are just very different. Firstly, core HR, payroll, general ledger, these are all processes that have to be right 100% of the time. There's no margin of error that's acceptable. This is fundamentally the wrong job for an AI agent that is built on a probabilistic architecture. So enterprises, they already trust Workday's governance and compliance capabilities. These policies can be used to ensure agents act in a desired way as well. Secondly, I think agents need accurate context to produce business value. Much of this context lives in the back office within Workday today. And as we mentioned earlier, this context is not leaving the system anytime soon. Because Workday is an entrenched part of enterprise IT stacks, they are in a position to monetize agents in multiple ways. If there is a third-party agent that wants to access Workday data, they'll have to go through Workday's meters and they'll have to pay consumption access. If a customer wants to build an agent on top of Workday, they can do that through Workday's premium priced modules like Extend Pro. Finally, Workday can sell their own first-party agents like payroll agent, financial close agent, audit agent, etc., to help customers automate processes in new ways that truly do deliver business value. We think that agents will proliferate in enterprise settings, and we think Workday is in a very good position to capture value from a wide variety of agent architectures.
So, Doug, why don't we close with valuation? You argue that Workday offers limited downside and meaningful upside. What's already baked into the stock today, and what is the potential upside?
We think today's stock price implies highly punitive assumptions, both for terminal growth and terminal margin. You can read all the details in our blog post. I won't get into all of the details here, but to simplify, for the current stock price to be fair, we would need a single-digit terminal revenue decline in year 5 of our discounted cash flow model, coupled with an EBIT margin in the high 30s. We think that those two assumptions together are overly punitive, and they're unlikely to occur. So should we find ourselves in that existential downside scenario where terminal revenue really does decline, we don't think that's likely. But if it does happen, EBIT margin is not going to be in the 30s. It's going to be at least double that, in the 60s or 70s. And we think that mature, sticky enterprise businesses that are today owned by financial buyers, companies like various private equity owners or Broadcom, for example, that are maximizing cash flow from mature software assets, we often see margins in the 60s or 70s. We don't think it's reasonable to see a margin in the 30s at the same time as we see a revenue decline for Workday. We think that's overly punitive and it's not going to happen, even in a downside scenario. Another cut at the downside is just to look at the backlog. So today, Workday trades for about 1 times its backlog, while other application software peers trade for multiples of their backlog. Many infrastructure software companies trade for over 10 times their backlog. Clearly, the terminal value risk that is often highlighted by bearish analysts, it's much more relevant for a highly priced infrastructure software stock or a company that is more perceived to be an AI winner than Workday. Workday's priced like it's going out of business very soon, and we don't think that's reasonable. So that's the downside, which we think is quite limited. Moving to our base case, we assume low double-digit revenue growth continues for the next few years with a gradual maturation towards GDP level growth rates over time, which is natural for a company that's maturing and scaling. And we think normal margins in the high 30s is reasonable for that to support that type of growth. Using these assumptions, our models get us to at least a double from today's stock price, plausibly a triple. And then if we think about the upside, which also could happen if the agentic opportunity scales like management thinks it could, further upside above our base case is possible as well. And so when we look at this risk reward, we think there's limited downside. We think there's meaningful upside and maybe a lot of upside in the upside scenario. That makes Workday one of our best ideas.
Great. That's all for today. Doug, really appreciate your time today, and thanks for sharing your insights with us.
Thanks for having me.
Thanks, everyone, for listening, and we'll see you next time on Inside Value Investing.